You applied for a business loan. You had a plan, decent revenue, maybe even a relationship with the branch manager. 3 weeks later, an email lands in your inbox. One paragraph. No real explanation. Declined. Here's what nobody at the bank will tell you. That decline almost never means your business is a bad bet. It usually means your business didn't fit the box the bank was allowed to say yes to. By the end of this video, you'll know exactly why banks decline loans that are actually fundable, and what to do in the next 30 days to get it funded somewhere else. A bank isn't a single decision maker. It's a credit box built by a risk committee, priced for a specific type of borrower, and enforced by an underwriter who has almost no discretion to deviate from it. That box usually has 4 walls: time in business, where most banks want 2 to 3 years minimum; debt service coverage ratio, typically 1.25x or higher; collateral coverage, often loan to value under 65 to 75%; and industry, where certain sectors are flagged as restricted internally, regardless of how the individual business performs. If your business is outside any one of those walls, even if every other number is strong, the underwriter isn't rejecting your business. They're following a policy that was written before your file ever landed on their desk. A bank decline is a policy outcome, not a verdict on you. Let's go through the actual patterns behind most declines. Startups and businesses under 2 years old get declined constantly, even profitable ones, because conventional bank underwriting is built around historical cash flow, not projections. The bank isn't saying no to your model. It's saying it can't underwrite a story yet. Then there's thin or inconsistent cash flow. Banks run a debt service coverage calculation using your tax returns, not your bank statements. So if you write off aggressively for tax purposes, which most owners are advised to do, your taxable income can look too low to support the loan, even though your actual cash flow is fine. This is one of the most common and most fixable reasons for a decline, and almost nobody explains it to borrowers. There's also collateral shortfall. If you're asking for more than the bank's loan-to-value formula allows against your real estate, equipment, or receivables, the file gets declined regardless of your revenue, and that's a math problem, not a character problem. Industry risk flags matter too. Cannabis, media and entertainment, certain hospitality categories, and some import-export businesses get declined by policy before an underwriter even reads the file. And finally, concentration risk. If one customer represents too much of your revenue or your business depends heavily on one supplier or one contract, banks read that as fragility, even if that concentration is actually a stable, long-term relationship. Notice what all 5 of these have in common. None of them are, your business is bad. They're all mismatches between how your business actually operates and the narrow underwriting formula a conventional bank is required to apply. Most decline letters say something like, "does not meet current credit criteria." That's not an explanation. It's a liability shield. Banks are cautious about stating specific reasons because specific reasons can create disclosure and fair lending exposure. Here's what to actually do. Call the underwriter or loan officer and ask directly which specific ratio or policy caused the decline. Most won't volunteer it unprompted, but many will tell you if you ask plainly. That single piece of information tells you whether you have a fixable problem or a structural mismatch. And that distinction determines your entire next move. So what do you actually do next? First, diagnose before you reapply. Reapplying at another bank with the same package, hoping for a different answer, is the single most common mistake business owners make after a decline. If the underlying ratio problem hasn't changed, you'll get the same result with a different logo on the letterhead. Second, match the capital source to the actual constraint. thin cash flow points you toward cash flow-based lenders that underwrite off-bank deposits instead of tax returns. Collateral shortfall can often be closed with asset-based lending or a blended senior mezzanine structure. Time in business points toward alternative and private capital sources with more flexible seasoning requirements. An industry flag means looking for specialty lenders who intentionally serve that sector because it's their focus, not their exception. Third, rebuild the package instead of just resubmitting it. A stronger package usually means clean interim financials, a cash flow narrative that explains the story behind the tax return numbers, and, where relevant, a letter addressing the specific concentration or industry issue head-on instead of hoping the underwriter won't notice. And fourth, know when to use a broker or advisor instead of applying serially. Every decline shows up on your credit file and can make the next lender more cautious. So if you've been declined once, the better move is often to work with someone who can pre-underwrite the file against multiple lenders' actual criteria before it goes anywhere, so you're not spending another 6 weeks finding out the same thing a second time. A bank decline feels personal. It isn't. It's a mechanical outcome of a rigid box built for a narrow type of borrower. The businesses that get funded after a decline aren't the ones that get lucky on a second try. They're the ones that diagnose the actual constraint and go to a capital source built to underwrite around it. If you've been declined and you're not sure whether the problem is fixable or structural, that's exactly the kind of question worth getting a second set of eyes on before you reapply anywhere.